Two types of companies we exclude from our investable universe. The first group are companies that have material exposure to controversial sectors, for instance, alcohol, tobacco, gambling, and also thermal coal. That's sort of a stock standard approach in the ESG world, I guess. That takes out some companies, but then the second bracket of company are companies where we think they're not meeting our minimum ESG requirements or ESG hurdles, typically companies which have low ESG scores in my rankings. That could be due to companies that have major corporate governance concerns. It can also be companies where there's been systemic underpayment of workers, etc., etc. And of course, over time, we'd like to engage with those companies to see them improve. And we think we have a vested interest in keeping the exclusion list small. But yeah, there are some companies there that are still there. So that takes out about 14% roughly of ASX 200. That's the first step, and that's a negative screen. But then we also have a positive screen on top of that, which means in the remaining universe, we rank them in a proprietary stock ranking tool, which takes half the input from my ESG research and half of the other input from the analyst conviction scores. So then we can rank companies in order from top to bottom. And in the portfolio construction, we have portfolio construction rules, which means we need to have a lot of companies from our top ranking in the way we populate the portfolio. And that's how we also take into account companies that are improving in ESG and have strong ESG credentials as well. Well, I mean, there are some companies, even though they're not excluded per se, that we still don't want to hold. Because for a company to be excluded, you need to have either material exposure to controversial activities, or there might be companies that have very major ESG issues. And then on top of that, there are companies which we think, well, they're investment grade, but we still don't particularly want to hold from an ESG perspective because they might have a low ESG score, or even worse, they might have a low ESG score and they're deteriorating. So from an ESG investing perspective, I think it's really important to think of ESG in a momentum way as well, because ESG integration doesn't necessarily mean investing only in companies with the strongest ESG profiles, because if you do that, you might end up with a very expensive portfolio. So we think it makes sense to maybe invest in companies sometimes where there's a positive trajectory, because we think by improving in ESG, these companies should ultimately have a premium valuation over time. So in some cases, it makes sense for us to invest in companies that are maybe medium range on ESG, but they're improving and they can demonstrate a clear commitment to improvement. Yeah, I mean, this is where it gets tricky too, because I think all companies try to talk about their sustainability credentials. If I go back 10 years ago when I started out as ESG researcher in Australia, there are quite a few companies where there was no disclosure whatsoever. Now I think it's almost the other way around. You actually get bombarded with information, so it's up to us to really go through all of information and making sure that the companies we pick are actually genuine. And there's so many different issues, and some of those issues, of course, are outside of companies' control. We talked about modern slavery before a bit, and climate change. There's a lot of issues which are very systemic in nature. But all up, I would say the majority of companies in ASX 200 that I cover have positive momentum, or at least there's more companies that are improving in ESG than deteriorating.